What if I told you that the biggest financial mistake isn't overspending, living beyond your means, or even falling for get-rich-quick schemes? Surprisingly, the real danger is doing nothing, allowing your money to sit idle instead of putting it to work. Many people assume that saving diligently is enough, but failing to invest can silently erode wealth over time. At first, this might seem counterintuitive. Most people believe excessive spending or debt accumulation is the greatest threat to financial security. However, inflation slowly eats away at savings. If your money sits in a traditional savings account earning minimal interest, its purchasing power decreases each year, meaning you're effectively losing money by not investing. Consider this scenario. You've saved $50,000 in a low-interest savings account earning 1% annually. In a year, you gain $500 in interest, but with a 3% inflation rate, the real value of your savings drops by around $1,500. Even though your balance appears to grow, your money actually buys less than it did before. This slow erosion of wealth is a hidden financial pitfall. Harvard Professor X, who has studied this extensively, warns that failing to invest is one of the biggest mistakes people make. He emphasizes that savings alone can never outpace inflation, and the only way to grow wealth over time is by actively investing. Without action, your financial future stagnates, and you fall behind. So, what's the solution? The key to financial success lies in making your money work for you through smart investments. While saving is responsible, relying solely on it means missing out on opportunities for real wealth creation. The first step toward financial freedom is recognizing that saving alone won't cut it. It's time to take action and start growing your wealth. Let's dive deep into real-world examples that demonstrate the real costs of inaction when it comes to managing money. You may have heard the saying, money doesn't grow on trees, but what you might not know is that money can grow if you let it. And conversely, when you fail to make it grow, it can wither away. Let's break this down with 4 illustrative examples that show you the profound impact of not investing your money and how doing so can literally cost you thousands, if not millions, over the years. You'll see how making small, smart changes in your financial habits today can drastically improve your future wealth. Example 1. The danger of stagnant savings. Consider the common scenario of someone who works hard and diligently saves their money. Maybe they're putting aside $10,000 every year, year after year, in a traditional savings account. Sounds responsible, right? But here's the catch. That savings account is offering a return of only 1% annually. On the surface, it feels like you're saving money and earning interest, but here's the hidden cost: inflation. If the inflation rate is 3% annually, it means that the purchasing power of your money is shrinking each year. So, even though you're saving diligently, you're losing money in terms of what that money can actually buy you. So at the end of the year, you might have $10,100 in your account, but in terms of what that money can actually buy you, it's worth less than what you had when you started. In other words, your money is losing value every year. Let's take a longer perspective. If you continue saving the same way for 10 years, and let's assume you're consistently putting aside $10,000 each year, at the end of 10 years, you'll have saved $100,000. At a 1% return, you would have earned $10,000 in interest, roughly. But when you factor in inflation, you're effectively looking at an $80,000 real value after 10 years, a significant loss. Now let's compare this to a scenario where you invest the same $10,000 in a diversified investment portfolio that yields an average return of 7% per year. With the power of compound interest, that initial $10,000 would grow to more than $19,500 after 10 years. In short, even if you just invested in something conservative like index funds or a diversified stock portfolio, you would have doubled your money over the same time frame. This is the power of investing. Money grows faster and combats inflation in ways that a basic savings account never could. Example 2. The perils of waiting too long to start investing. The biggest regret many people face in their financial lives is waiting too long to start investing. If you don't start early enough, the impact of compound interest, the snowball effect of earnings generating earnings, can work against you, making it much harder to build substantial wealth. Let's compare 2 people. Person A starts investing at the age of 25. They decide to invest $5,000 every year into a diversified portfolio that yields an average 7% return annually. By the time they reach the age of 65, they will have accumulated approximately $1.5 million. Person B, however, waits until the age of 45 to start investing. They contribute the same $5,000 every year, also with an average 7% return. By the time they reach 65, they will have accumulated only $500,000. The difference? Despite both individuals investing the same amount of money each year, Person A ends up with 3 times more than Person B simply because they started 20 years earlier. Time is a critical factor in wealth building, and compound interest is much more powerful when you start early. Example 3. The hidden cost of debt and the importance of paying it off. In this third example, let's take a look at someone who, instead of saving or investing, has accumulated high-interest credit card debt. Many people rely on credit cards to cover expenses, but what they don't realize is how much it can cost them in the long term. Let's say someone has $10,000 of credit card debt with an average 20% interest rate. On the surface, it might seem manageable because the person is only required to make the minimum monthly payments. However, here's the kicker. Those payments barely cover the interest, and the principal debt doesn't decrease as fast as you might think. If this person only pays the minimum due every month, it could take over 20 years to pay off that $10,000. And guess what? They will end up paying nearly $30,000 in total, the $10,000 debt plus $20,000 in interest. What could this person have done with that extra $20,000? If they had used that money to invest in a stock portfolio that averaged a 7% return, their investment would have grown significantly over the same period. Let's say they had invested that extra money. At the end of 20 years, they could have ended up with $75,000 or more. Instead, they've wasted it on interest payments that contributed nothing to their wealth. The sad reality is that credit card debt, with its high interest rates, can quickly eat away at your financial future. High-interest debt does not allow your money to grow, and in fact, it prevents you from building wealth. If you're not actively paying off your high-interest debts or prioritizing debt repayment, you're essentially locking yourself out of the wealth-building process. Example 4. The power of diversification. Let's consider a final example involving investment diversification. If someone only invests in one type of asset, say, just one stock or one real estate property, they risk losing everything if that one asset falters. The key to protecting your wealth and ensuring growth is diversification, spreading your investments across various assets like stocks, bonds, real estate, or even commodities like gold. Imagine 2 investors. Investor A puts all their money in one company's stock. While the company performs well in the beginning, a sudden market downturn causes the stock price to plummet. Investor A loses a large portion of their portfolio. Investor B, on the other hand, diversifies their investments, spreading their money across multiple assets. While some investments may lose value, others continue to grow, and the overall portfolio remains stable. By diversifying, Investor B has protected themselves from the risk of losing everything from a single downturn in one market. This is why it's crucial to diversify. It minimizes risk and maximizes potential growth. The key takeaway here is that time is of the essence when it comes to building wealth. The earlier you begin investing, the better your chances of success. Even small actions like paying off high-interest debt or starting a retirement account can have an outsized impact in the long term. Don't wait until it's too late. Start making your money work for you today, and you'll thank yourself tomorrow. Stay tuned, as our next video will demonstrate how to avoid common financial mistakes and begin building your wealth.